Welcome, everyone, to the Nichols Tax Update Podcast for March 22nd, 2021, Issue 2112. This program is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. You are receiving it as a member benefit from the South Carolina Association of CPAs. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in the program. I always acknowledge the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts, the preeminent source of information for tax professionals, headquartered in Washington, D.C., and wired in to the sources of good tax information. Well, what's in this edition? 12 topics. It was an overwhelming week. I've got 12 topics. We're going to go at a pretty rapid clip, I suppose. But these are the things that caught my attention last week that I think you should pay attention to, be aware of. Maybe you want to look up. Maybe you just need to know that it's there. First, the return filing deadline has been extended to May 17th. I think that's had a lot of publicity. Everybody knows, but there is a hook. There is something else you need to know. Then the American Rescue Plan brings tax compliance headaches with financial assistance for millions of taxpayers. The taxpayer gets the financial assistance, and me, the return preparer, I get the headache. The IRS reminds us of all the tax incentives for manufacturers. We should be aware of those, and if we're preparing returns, giving a tax advice to manufacturers, we need to make sure that we take advantage of those. Then we get a sneak peek at the American Rescue Plan Act tax compliance issues with financial relief provisions in tax years beginning after 12/31/20. There are only two minor issues for 2020. All the action is in 2021. So really what we need to learn about the American Rescue Plan Act is for planning in 2021. And the IRS has brought another practice unit. Not a moment too soon. This is a great one. It instructs us on the income tax accounting for the sale or exchange of a partnership interest. We have all these limited liability companies, all these defaults to partnership status. We've all had to learn a lot about partnership taxation. Everyone has trouble, including me, accounting for getting the tax accounting for the sale or exchange, a taxable exchange of partnership interests, and when you have different mixes of assets, depreciable assets, appreciated assets, capital accounts that are different from basis, this practice unit will help you resolve some of those issues. How do I file a Form 1040 excluding unemployment benefits? There is guidance. S-Corp distributions to an attorney, officer, shareholder were wages. This is a common misunderstanding. I thought that I would slot this into this week because we're going to be preparing returns, and our client's understanding is not probably correct here if they think that they can distribute money to themselves from an S corporation without paying wages. The question then becomes, I pay reasonable wages, then can I justify some balance between wages and distributions that are based on capital or other income producing factors? A 10% additional tax applies to an IRA distribution. The taxpayer thought that separation from service was enough, but no, separation from service before you're age 59 and a half is in itself not enough to avoid the 10% additional tax. And the IRS advises, do not file amended returns too soon. If you filed a return in paying tax on unemployment benefits, for example, don't file an amended return. The IRS is going to catch that automatically, right? And they'll send us a refund. Don't get so excited. Don't get too excited filing amended returns. I'll give you the reference where you can see what the IRS has to say about that. And then the AICPA has written a letter asking for clarification on the timing of tax-exempt income exclusion, the treatment of S-Corp expenses, and proper reporting. The forgiveness of debt is a particular problem with S-Corps and partnerships, as you know, because we have the effect on basis of debt and debt forgiveness. Then a reminder that the CARES Act changed the required minimum distribution rules, and some of you may be giving advice on RMDs for 2021. We need to know the change in the rules. Then distributions of gaming revenue are taxable income to members of the Miccosukee Indian tribe, despite the bad tax advice they got from their tribal leaders, and even advice to enter into a conspiracy to avoid reporting the income. I'm amazed that the IRS has not taken in after these so-called tribal leaders that gave not just bad tax advice, but abusive tax advice, advising the members of the tribe to actively attempt to hide their income from the distributions of gaming revenue from the IRS. Well, that's a lot to talk about. Let's get started. Filing 2020 returns is extended to May 17th, 2021. However, and you're going to automatically avoid penalties and interest on taxes as long as you pay them by May 17th. However, the relief does not apply to your estimated tax payments, which are still due on April 15th, or to state tax payments or deposits of payments of any other type of federal tax. It only applies to the filing of returns which were due on April 15th. They are now extended to May 17th, but you still have to file your first quarterly estimate on April 15th. I don't know why they can't get that straightened out. Preparers need guidance on how to report unemployment exclusion and the new credits. I refer you to an article in Tax Notes Today on March the 15th by William Hoffman. New, expanded, and even retroactive rules and benefits in the American Rescue Plan Act of 2021 will provide financial assistance for millions of taxpayers. However, those same provisions are causing serious headaches for tax professionals who are assisting in preparation of filing of accurate returns. The most troublesome provisions seem to be in the investment incentives for business, the employee retention credits, excluding up to $10,200 of unemployment compensation, non-taxable economic impact payments of at least 4 different types and kinds, periodic advanced child tax credits, advancing the child tax credit in circumstances where the parent's economic circumstances may change and you run afoul of the phase-out limits when you didn't think you were going to when you took the monthly payments, and so now parents can find themselves liable for tax they didn't expect to have to pay. That's going to create lots of interesting back and forth with the IRS. And then different phase-out thresholds. Make sure you get those in your mind, right? There are different phase-out thresholds for child tax credits, for the earned income tax credit, for the $10,200 unemployment compensation. That's a cliff, not a phase-out. That's a $150,000 cliff. The effect of credits on deductions. Which credits require you to reduce your deductions and which do not? And I got to the bottom of this slide and I said, and on and on and on and on. You really need to dig into the details, and Bill Hoffman's article in Tax Notes Today will give you a head start. Income tax incentives to encourage U.S. manufacturing are not necessarily new. However, we find that some U.S. producers, manufacturers, are not taking full advantage of these as they should. So the Joint Committee on Taxation prepared a summary of these incentives in preparation for a hearing before the House Ways and Means Committee to talk about changes in the U.S. tax system that can benefit manufacturers. We already have a 21% tax rate. We have the domestic production income deduction, which allows us to exclude up to 20% of our income from manufacturing from our taxable income. We have accelerated cost recovery provisions to allow us to write off the cost of new machinery in the year that we place it into service. We have research credits. So this is a good time to review your manufacturing clients' tax and economic planning. It's not just about filing the 2020 tax return. It is about working with your client to determine how they might best take advantage of all of these tax incentives to better their business in 2021 and years thereafter. The American Rescue Plan Act, the ARPA of 2021, what's in there? Well, most of what's in there is effective in 2021 for at least a year. Some 2 years, some 5 years. Only one forever. The coronavirus pandemic economic relief, expansions of the child and earned income tax credits, additional economic recovery rebates, and a suspension of taxes on unemployment compensation. That's a quick summary. But I've broken this down, and I'm going to share a secret with you here. We're going to provide these 6 subtopics. We're going to give a little separate program on each of these subtopics so that everyone can work these into their schedule. The Revenue Procedure 2021-20 is the thing that is causing the most trouble for all the credits. We're going to talk about that, but we'll have a little separate slideshow on the child tax credit, a separate one on the earned income tax credit, a little separate program on dependent care assistance, paid sick and family leave credits, and of course the restaurant revitalization credits. The best use of your time right now is probably to be sure you understand the limited application of changes after the CARES Act. The American Rescue Plan Act changes for 2021 are going to be effective in 2021, and they're going to affect your 2021 returns. This practice unit, which is what the IRS calls them, income tax accounting for the sale or exchange of a partnership interest, is a big deal. It's a big deal that's hidden from view. I've talked about these practice units before in this program. The IRS here explains how to handle the income tax accounting for taxable ownership changes, proper reporting of gain or loss, proper consideration of the partnership section 751 or section 1250 property, consideration of a section 754 election, and this is explained comprehensively with a glossary of terms, with technical references in 50 PowerPoint slides. The IRS offers us examples and analysis of 5 issues common to taxable transfers of partnership interests. They tell us how to calculate the gain or loss for the selling partner and how to determine basis for the acquiring partner. This practice unit tells us when and how we have to recognize ordinary income and how to separate the ordinary income from the capital gain. And then the importance of a section 754 election when there is a transfer of interest, a taxable transfer of interest in a partnership. Maybe this partnership has already made a 754 election. If so, it continues to apply. If they have not made a 754 election, you need to do the analysis to determine whether a section 754 election allowing you to reestablish perhaps a stepped up basis for the new partner's share of partnership property would be to the new partner's advantage or not. Sometimes it's not wise to actually have a section 754 election because the fair market value of the partnership property has dropped. There you would lose basis. So this practice unit literally takes you by the hand. Remember, it was designed to train IRS agents. If they can do it, you can do it. And you can do it with the IRS tools. Instructions for excluding the unemployment compensation are on the IRS webpage, updated on the 12th of this month. Individuals with less than $150,000 of income may exclude up to $10,200 of unemployment benefit. When you go over $150,000, you're going to pay tax on all the unemployment compensation. So follow the IRS instructions and get this, the IRS has provided an unemployment compensation exclusion worksheet. You can download it from www.irs.gov. If you've already filed, don't file an amended return. The IRS is going to identify, calculate, and process your refund. Unemployment compensation overpayments that may have been repaid in 2020 should be subtracted from overpayments made and the total entered on the worksheet, including the word repaid. An attorney, not particularly successful, was an employee of her S corporation, so S corporation distributions were wages. Just judging from the record in this case, it would appear that Letisa Ward, whether she was a good lawyer or not, had difficulty managing her finances. She was unable to pay her bills at one point and had income from forgiveness of indebtedness. A credit card company decided that she wasn't worth pursuing, but she organized her legal practice as a S Corp. She was the only officer, therefore she is an employee by definition. If an officer of an S corporation is by definition an employee, so distributions to her were wages. Her income tax reporting, in not only for the corporation but also for herself, was careless and led to an IRS exam based on conflicting information between her Schedule C and the 1120S. She tried to report the S corporation income in her Form 1040, so apparently whatever her legal training was, it didn't include the Internal Revenue Code, and she did not report debt forgiveness income. This opinion, quite accidentally, includes a discussion of insolvency as an exception to recognizing income from forgiveness of indebtedness, and it makes the point that we test for insolvency immediately before the forgiveness of debt, which we're testing for recognition of income. It's a great discussion of the exclusions, the Section 108 exclusions for income from forgiveness of indebtedness if your circumstances lead to qualifying you to not recognize the income. Get tangled up in my my dentures. Right? Additional income tax on early IRA distributions. You got to be careful here. You can avoid the additional income tax if your early distribution is based on disability. You can avoid the additional income tax when you're over age 55 and you separate from service, but you can't avoid the additional income tax just based on the separation from service when you're under age 59 and a half. Take a look at Code Section 72T2, capital A, small letter V. That does not apply to early IRA distributions in every circumstance. The AICPA can't figure out how to report the tax-exempt income from forgiven loans either. It isn't just you. They've written a letter to the Internal Revenue Service requesting further guidance on the tax treatment of tax-exempt income from forgiven PPP loans that are made to partnerships and S corporations. We don't have any problem with those loans that are made to corporations, but the forgiveness of loans to partnerships and S corporations has a significant effect on the partners or the S corporation shareholders' basis for reporting losses. The AICPA letter highlights uncertainties and it proposes solutions for the timing of tax-exempt income exclusion, proper treatment of the qualified PPP expenses for S corporations as being different from partnerships, and proper reporting in partnerships. A reminder, please, of the changes to the required minimum distribution rules. You now have to start taking your money only after you are attained age 72 by the end of the year of your first distribution. And the CARES Act provides relief for withdrawals, hardship withdrawals, up to $100,000 without an early distribution penalty. And it suspends the mandatory 20% withholding, so you can get all of your money, and it extends the time for repayment. You're well advised, if you have if you have clients that need to take money out of their retirement plan, you're well advised to inform yourself about these changes in the CARES Act to the required minimum distribution rules. Casino revenue distributed to the Miccosukee tribe members is taxable income. Their tribal leaders advised them to cheat on their income taxes. This is just outrageous. The 11th Circuit of Court of Appeals finally got this case. James Clay and his wife had not reported as taxable income over $100,000 per year each. The Miccosukee tribe hit it rich when they allowed a casino to be constructed on tribal land, and they made a deal to own the casino. They're making money hand over fist. Every member of the tribe, man, woman, and child, got over $100,000 a year in the years under exam here. Those distributions are not exempt from taxation. Tribal leaders told everybody in the tribe how to hide the money from the IRS and told people that the money was not taxable. That's dead wrong. There's nothing in the law that protects the revenue from a casino from being taxable to the members of an Indian tribe. By the way, that symbol up there, let me get my pointer in the right place. That symbol, there, yeah, okay. That symbol up there, that's a dream catcher, believed to bring good dreams and good life to its owner, but it didn't help with the income tax liability. That's a wrap. It's a long program this week. Thanks for staying with me, and until next time, please stay safe. I need you. We all need each other.